In the world of investing, every now and then a number pops up that just makes you stop in your tracks. A number that seems almost too good to be true. Well, today we're going to tackle one of those numbers and the investment behind it that has a lot of people talking. So let's get right into it. Just look at that number, 25.2%. That's not a typo. That is the advertised annual distribution rate for one single ETF. I mean, we're living in a world where a 5% yield is considered solid, right? This thing is an absolute monster. It's the kind of number that makes you lean into your screen and go, wait, what? And that, right there, is the million-dollar question, or maybe the billion-dollar question. When you see a yield that high, you have to wonder, is this the deal of a lifetime? A brilliant, kind of undiscovered gem? Or is it a trap, a siren song luring people towards some really nasty hidden risks? Well, that's exactly what we're going to figure out today. All right, so let's get into the 25% yield puzzle. We're unpacking the Rex, FANG, and Innovation Equity Premium Income ETF, or FEPI. Yeah, FEPI. That's the fund at the center of this whole mystery. And our job today is to basically take this thing apart, piece by piece, and figure out what makes it tick. Okay, so what is this thing, really? At its core, FIP is pretty new. It just launched in October 2023, and it's actively managed. And its portfolio? Super simple. It's just 15 big-name tech and innovation stocks, all equally weighted. But here's the key. Its main goal isn't really capital growth. Nope. It's designed to spit out a ton of cash income every single month. And it uses let's call it a very specific strategy to generate that massive yield. So let's talk about how FIPI makes its money. This is really about the mechanics behind that magic number. I mean, how on earth do you get a 25% yield from a bunch of tech stocks that, let's be honest, pay tiny dividends, if any at all? Well, the answer isn't magic. It's all about financial engineering. So let's pull back the curtain and see how the trick is done. The engine driving this whole thing is a strategy called a covered call. Now, that might sound complicated, but the analogy is actually pretty simple. Think of it like this. The fund buys the stocks, right? That's like you buying a house. Then it sells what are called call options on those stocks. That's kind of like renting out a room in your house. For doing that, you get to collect an upfront fee, the rent, which in the investing world is called a premium. And that premium, that's where almost all of that giant 25% yield is coming from. So when you boil it down, FIPI's income process is just 3 simple steps. First, they buy that portfolio of 15 big tech and innovation stocks. Easy enough. Step 2, they sell call options on those stocks, basically renting out the upside to collect all that cash premium. And step 3, they take that cash and just distribute it straight to the shareholders every single month. Okay, but here's where we hit our first and honestly our most important catch. You've got to understand there are 2 very different kinds of yield. You see the big, flashy distribution rate of about 25%? That includes all that cash from the options. But then you look at the official SEC yield, the one that only measures traditional income like dividends, and it's actually negative 0.29%. Whoa, that tells you everything you need to know, right? 100% of that giant payout is being manufactured by the options strategy. It has nothing to do with the actual earnings of the companies in the fund. All right, so let's talk about the price tag for that high yield. Because as any investor will tell you, there is no such thing as a free lunch, especially not in finance. A yield this high has to come with a catch, a pretty significant price tag. And that brings us right to the inherent risks that are baked right into FEPI's DNA. And this right here, this quote gets to the absolute heart of the issue. 100% of its distributions are classified as return of capital. Now, what does that mean? It's not profit, it's not a dividend. In the language of accounting, it means the fund is literally just handing you back your own money, a piece of your original investment. And that, my friends, has massive implications. So, this whole return of capital thing, it raises a whole bunch of red flags. The biggest one? The very real possibility that your investment could just shrink over time. On top of that, you're giving up the chance for those huge gains these tech stocks are known for. You're also basically putting all your eggs in one very specific basket, and the entire strategy relies on the market being in just the right mood. So, let's tackle risk number 1, a shrinking pie. This is a concept called net asset value erosion, or NAV erosion. The NAV is just the total value of everything the fund owns. Now, if the fund is constantly paying you out of that pot of money, but the stocks inside aren't growing fast enough to replace what's being taken out, well, the pot gets smaller. It's exactly like a farmer eating their seed corn. Sure, it's a meal today, but it means you've got less to plant for the harvest tomorrow. All right, on to risk number 2, capped gains. So remember how the fund rents out its potential for big gains? Well, here's the consequence. Let's say the tech stocks it owns just go on an absolute tear, a massive bull run. FEPI doesn't get to enjoy that full ride. Because it sold those call options, it's basically forced to sell its winning stocks at a pre-agreed, much lower price. So yeah, you get your monthly check, but you completely miss out on the explosive face-ripping rallies that these kinds of stocks are famous for. And that brings us to risk number 3. All your eggs are in one basket. I mean, one of the first things you learn in investing is diversify, diversify, diversify. FEPI kind of does the exact opposite. It's holding just 15 stocks, and they're all in the same super volatile tech sector. If that one basket gets dropped, well, everything inside breaks. Okay, so with all these pretty serious risks, why is anyone even talking about this thing? Why are investors biting? Well, to be fair, we have to look at the other side of the coin. There is a case to be made for a 25% yield, a bull case, if you will. The folks who are into FEPI make a few key points. First, they say we're in an income-starved market. Safe yield is just hard to come by, and people are desperate. For someone who values high monthly cash flow over literally everything else, FEPI looks incredibly tempting. Another argument is that it's not supposed to be your main investment. It's a small, tactical satellite holding, a little bet on the side. And finally, some people believe we're in a kind of market sweet spot right now, where volatility is just perfect for this kind of option strategy to really shine. So let's bring it all home for the final verdict. We've looked under the hood, we've seen the risks, we've heard the bull case. So what is this thing? Genius, a gamble, or something else entirely? This table, I think, really puts it all into perspective. Look at your typical income investments. High-quality bonds might get you, 3 to 7%? Dividend stocks, maybe 3 to 6%. Even traditional covered call ETFs usually top out around 6 to 12%. And then you have FEPI, way out on the far end of the spectrum, promising 20 to 30%. It just dwarfs everything else. But it gets there by taking on the most extreme risks on the chart, that NAV erosion and the super high concentration. So look, if you were to even think about putting money into something like this, you would need some seriously strict guardrails in place. We're talking keep the position tiny, like 5 to 10% of your portfolio max. You absolutely have to understand the risks of return of capital, that you're getting your own money back. This has to be a supplement, never a replacement for your core income. You need a clear exit plan for when things go south. And above all, you better be ready for the crazy volatility of the tech sector. So here's the big takeaway. FEPI is not a scam. It's not. It does exactly what it says on the tin. But, and this is a big but, it's not a magic money machine. What it is a highly specialized, super high-risk tool. It's built for a very specific job and a very specific kind of investor, one who knows exactly what they're giving up to get that massive yield. And that really leaves us with the one question every single income investor has to ask themselves, especially when they see a number like 25%. The yield is what you get. It's the big, flashy promise. But the real question, the most important question, is always this: what are you giving up?